Actually, in a range for 50 years, from $4 to 50 to $4 to 50, and if you look during that same period, 1970s through 2011 peak in silver when it hit 50 again until now, just recently, a couple months ago, broke through that. There's another spread chart. Well, I want to get to another one first. This is one that hasn't broken out yet. This is the really important one right now as far as I'm concerned about February, March, okay? We don't see the technical dynamics for a top. And when we see a top, and by the way, we do call tops in gold. 2011, 2 months, 3 months off the high, we said, that's it. It's over. Bear market coming. Reality from happening. And ultimately, once the market unleashes itself, as it has, even on a net price basis, it said, I'm not going to live in that old range again. Okay. Well, our momentum work said that before that even occurred in price. Momentum said, you're free versus gold, I guess. Okay. Yeah. It's sort of like the miners versus gold, off the page cheap. Okay. Well,
we've reached the end of February, and it's time for the Sprott Money Monthly Wrap-Up. We do these every month, and it's time to do it. I'm your host, Craig Hemke, and joining me for your monthly wrap-up is my old friend Michael Oliver, one of Eric Sprott's favorite analysts. He runs Momentum Structural Analysis. We'll talk about that in a second, and we're going to get Michael's views on this month and where we are going forward. Michael, good to see you, brother.
Good to see you again, Craig.
Hey, look, again, get started here. It's going to be March. I mean, if you've been putting off doing your taxes, it's probably time. You need to fund that RRSP or IRA account and buy some physical metal. Sprott Money will help you do it. Go to sprottmoney.com or give them a call at 888-861-0775. Get some metal out of the hands of the bankers, force more deleveraging of the system, and maybe we'll get some actual price discovery. Michael, let's get some actual price discovery. We ended January on an interesting note, right? With prices collapsing into the monthly close conveniently after Shanghai and London are closed back on Friday the 30th. But we recovered nicely, and the long-term charts don't look that bad. As we record this here on Thursday the 26th, the gold price is up almost 6% on the month, even after that washout. Silver's up about 2%, so it's kind of, trying to do its thing. The shares are doing great. The GDX is up nearly 19% on the month. I think we should start with, though, as we narrow in on the end of the month, the events of late Wednesday, the 25th. Michael, you have been, I always like to say, you've been doing this since your days at E.F. Hutton. And when Michael Oliver talks, people listen. Brother, you've been around these commodity markets for 50 years. You ever seen things like yesterday? How often does that happen?
Very seldom. It's too peculiar to be, an accident. That's not our expertise at MSA. We analyze markets via their momentum, structural behavior, technically, in other words. But these events are just bizarre, and when they occur is bizarre, and how limited it is. In other words, it wasn't the whole CME went down,
Right?
It's just silver, gold, and natural gas too. So we can't just say it was, they were manipulating silver because natural gas got shut down too. But anyway, any attempt by any force, whether government, brokerage firms, whatever, to restrain a market from doing what it otherwise would do in reality, merely compresses the explosive effect. Whereas if you hold something back and it should have been there, but you're keeping it back, when you finally crumble, as the enemy overruns you, okay, it's probably even more compressed then with explosive behavior, in the case of silver, upside explosive behavior, than it would otherwise be. Markets make errors. Markets aren't always rational. It's a false assumption. And whenever markets do make an error, we see this in bubble stock market tops, for example, where the market gets overpriced for too long, like the .com top, let's say. And when it unleashes itself even more than it probably should. If one error goes to another. Well, silver has been irrationally in a range for 50 years. From $4 to 50 to $4 to 50, and if you look during that same period, 1970s through 2011 peak in silver when it hit 50 again until now, just recently, a couple months ago, broke through that. No other market's been restrained like that. Copper hasn't. Copper lived in a range from 50 cents to $1.50 a pound during multiple decades, 70s, 80s, 90s, 2000. And in late 2005, it said no more. Boom. It went to $4.50 in a matter of a couple of quarters from a zone that on average was $1. Silver's still in its 50-year range, though. Lead, another exciting market. 2007 did the same thing. It had been in a range for many decades and suddenly quadrupled basically in price in a matter of a couple of quarters.
Oliver's framework here is the core of everything that follows. The bridge over the River Kwai metaphor is the most important concept in MSA methodology, a momentum structure that, when broken, tells you a market has turned. In 2011 and 2015, those bridges were clearly visible on the silver momentum chart, and when they broke, price followed. Today, there is no such structure anywhere near. This means the market literally does not have a technical reason to have topped. The 30% one-day drop was a sentiment event, not a structural one. For traders who entered late at $120, it was painful. For anyone who entered at Oliver's buy signals, late June at $35, or the November spread breakout signal in the 50s, it was simply noise. The $300 to $500 target sounds extreme until you map it against copper's two-quarter repricing in 2005, lead's quadrupling in 2007, and gold's eightfold move from its prior lows. Markets that have been held in artificial ranges for decades do not gradually crawl upward when they break out. They gap violently to a new reality.
And once it did, it lived in a new reality of price level compared to that old reality. Well, silver on a net price basis, if you're just a stupid price chart looker, okay, you got a breakout a couple months ago, getting above 50. Okay, fine. First thing it did is go to 122. Bam. Oh, more than doubled the range. The range was what, $4 to 50, $4 to 50.
Yeah.
It was like a $45 range, let's call it. We'll add $45 to 50, and it says, well, the swing objective would be 95, right? Thickness of the range added to it. The orthodox. Yeah. Well, it went past that. So that notion is no good anymore. So silver said, no, I'm not going to be confined by old rules. If silver does what copper did in 2005-06, or what lead did in 2007, or what gold has done repeatedly at each of its bull market peaks, it goes way beyond the old peak. We project and have projected for months now that when this thing unleashes to a new reality, we call it silver, it's probably going to be, $300 to $500. And only then I think Eric Sprott pointed this out in an interview he did some months ago, that if you factored in just the decay in the money unit, and there was the increase in the quantity of the money unit, the M2, and factored that back to 1980 or 2011, silver would well be in the hundreds just to get even to those equivalent price levels and reflect the decay in the real buying power of the dollar. And the fact that there might be entities that try to restrain this process, and obviously it hasn't been working. We're not still in the 50s again, okay? They only accelerate it, and they create these boom effects. So it wouldn't shock me somewhere down the road here in the next couple months even to see something like, a couple $10 days in silver or $20 days on the upside. Bam, bam, bam. Where it's just gas. Okay. While it seeks its new reality.
Michael, we've known each other now for a couple of years. And I remember when we were talking last year, and so, gold had already taken off and silver's starting to play catch up. And it was about then you started talking about, not just going through 50, but, going through 100 and 200 and beyond these targets that you're talking about. And I've been preaching against this I call it the fractional reserve and digital derivative pricing scheme, right? Where you're not really trading physical metal. You're swapping these derivatives back and forth. Yeah. And I would sit there and look and go, I can see where he's coming from, but how do we get there without blowing up this pricing scheme, without making it obsolete because the metal's not there backing the derivatives? And then you get things like Wednesday the 25th, and I start to think, well, heck, maybe that's how we're going to get there. Maybe that's how it combines all of this together into your price targets. What do you think of that?
Yeah, these things are compression effects, and they're wrong. In other words, they're trying to keep reality from happening. And ultimately, once the market unleashes itself, as it has, even on a net price basis, it said, I'm not going to live in that old range again. Okay. Well, our momentum work said that before that even occurred in price. Momentum said, yeah,
Mm-hmm.
you're accelerating.
Right.
In fact, June of last year, silver was coming back up to 35 again. It had already been there a couple times in late 24 and early 25, just above 35. And it dropped hard into April, if you recall, last year. It came roaring back up. And when it was about 34 plus, we said, okay, this time it's different. You're going to accelerate. And sure enough, we went from 35, bam, up
Yep.
to over
Yep.
50.
Yep.
And
You're
then
right.
something else happened. And it's a metric we're watching that most people aren't.
The silver to gold ratio is arguably the most powerful single data point in the silver bull case, and Oliver's historical calibration makes it concrete. At 1% last year, silver was cheaper relative to gold than at any point in the modern era. At the 1980 peak, it was at 6.5%. That is a potential six-fold repricing just in the ratio, on top of whatever gold itself does. If gold reaches Oliver's $8,500 log scale objective and silver reaches 3% of that price where it was in 2011, silver is at $255. If it reaches the 1980 ratio of 6.5%, silver is at $552. These are not wild numbers. They are the historical reference points for two prior bull markets, scaled to today's gold price objective. The breakout above 2% on the monthly relative performance chart, with a clear ceiling that had held for multiple years and was just broken, is the technical confirmation that this rebalancing process has begun.
But we see it as a dynamite metric. And I've sent you some charts that make this point. A lot of people like to look at a price chart, and obviously if you just look back a year or two or three and what's happened then, you see this verticality and you think, oh my gosh, I can't get in that. That's
Right.
I missed it. It's going to crash, et cetera, without looking at the context of the longer term reality that it has existed for more than a half a century. Okay. But momentum said, no, it's over. We're coming out of here. Okay. And then price joined. Usually it's lagged to its own momentum. Okay, fine. But and so that's our main analysis, is the momentum analysis of the price action. And when we plot it, we get different visual view of the trend structures that you might see on a price chart, like the ceiling going back 50 years on price at $50, $50. Okay. Well, on momentum, you have similar structures, but they broke out earlier. Okay. We're plotting price in relation to a moving average, and we're oscillating it. So it's not just like overlaying a moving average on a price chart. Everybody does that. But
Right.
where is it in relation to that average? And you create an oscillator, and it gives you a different visual picture sometimes. And usually it will lead price. Okay, forget that. We stepped away from that a bit, and we also looked at relative performance of this versus that. For example, some big things happened on relative performance in the last 3 or 4 months. For example, the issue is for an investor, what's a better place to be? It's always the question. And it's always, well, within the S&P, where's the best place to be? But how about thinking beyond that? Maybe gold is a better place to be than the S&P, or gold and related things. Okay. And if you go back after that 2011 peak in gold collapsed in price down to from $1,900 down to $1,050. And its relative performance to the S&P, and this is the first chart that is being put up, it shows the monthly closes of gold plotted as a percent of the price of the S&P. And each month you plot that reading, okay? And when you do, you'll see that there's a trend line, gradual trend line going all the way back to 2014. So like 11, 12 years where you've bumped this line, bumped it. It's a super clear structure, not on a price chart, but on a relative performance chart. Gold broke through that in November, meaning gold performance broke through this resistance level it had with the S&P, where it had been confined, but basically going sideways for 14 years or so, a dozen or so years. And finally, it punched through this line in November. Well, where was gold in November? $4,200.
Yeah.
Okay. November. Okay, let's start the clock in December, because the breakout was the close in November. December, January, now February. 3 months later, we're $1,000 higher in gold net price, and the S&P is unchanged from where it was 3 months ago. Okay, so when these spreads break out, it often does not just signal, oh, one's going to do better than the other. But if the dynamics of that breakout are so clear as this chart is, and it's fresh, you just broke through a dozen-year base that anybody with a crayon could plot the line. You just broke out a few months ago. This is not ending. This is something that's just beginning. And the initial price response to that spread breakout was $1,000 gain in gold, and S&P sitting there kissing itself. Okay? Wow. In other words, the spread breakout yielded a massive price surge. At the same time that happened, there's another spread chart. Well, I want to get to another one first. This is one that hasn't broken out yet. This is the really important one right now as far as I'm concerned about February, March. Okay. XAU index goes back into the 1980s. It's the Gold Silver Miners Index, Philadelphia. Gold Silver Miners Index.
Gold Bug Index, or whatever they call it.
XAU. Okay.
Yeah.
And if you plot it in relation to an ounce of gold, divide the price of XAU in an ounce of gold, go back to the 1980s, and you'll see that on the left side of that chart.
This four-framework convergence is Oliver's most rigorous and most quotable section. He is not pulling numbers from sentiment or hope. He is applying four independent mathematical methodologies to the same question and getting the same answer range each time. Framework 1. Gold's own historical log-scale bull market multiples produce $8,500 gold, now validated by J.P. Morgan independently. Framework 2, silver's historical ratio to gold at prior bull market peaks, 3% in 2011, 6.5% in 1980, applied to $8,500 gold produces $250 to $552. Framework 3, M2 monetary supply expansion since 1980 and 2011 to simply restore silver's real purchasing power parity with those prior peaks requires several $100s. Framework 4, the log-scale swing objective from the 50-year $4 to $50 range. The arithmetic objective was $95. Silver blew past it at $121, confirming the log-scale $500 objective is the correct one. 4 frameworks, same destination. And Oliver's point about the tantrum is the key behavioral insight. Markets that have been mispriced for decades do not gradually correct. Copper did not crawl to $4.50 over 10 years. It got there in 2 quarters in 2005. Lead quadrupled in 2 quarters in 2007. Silver has been in an artificial range for 50 years.
It oscillated in a range for decades with lows about 17.5% to 18%, meaning XAU would drop down to that relative value to gold, and highs above 30%. So if you look at that range and sort of divide it in half, you'd say, well, it lived on either side of about 25% of an ounce of gold. XAU expresses an ounce of gold. It collapsed in that bear market in 2015, got all the way down to 4%.
Oh,
in other words, the miners used to be worth 25% of an ounce of gold. Then they went to 4%. Okay, now what are they going to do? Go to zero? Okay,
right.
Screw your head on. Okay. Since then, that spread has lived in a range, perfect little box, for a dozen years plus, with highs at the same level. Every time it goes up to like over 8%, it gets knocked back down a bit. It doesn't go back to that 4% level. No, it didn't. It left that alone, but still lived in a range. You're now with 1 day left in the month. If you close tomorrow where the spread is right now, you're going to break out of that massive spread range. Similar to that line we broke out of, where gold broke out over the S&P. Okay, November, and shot up $1,000. Even in the pullback, it's up $1,000 in price. Not just beating the S&P, but also a surge in gold. Well, here the gold and silver miners relative to gold are saying, I'm back. I'm reborn.
Yeah.
And I'm still at 8.7% of the price of gold compared to lows that were 17, 18%. In other words, when you look at that chart, if you broke out of that base and ran up to the bottom end of the multi-decade prior range of reality,
right,
you'd more than double the current relative value of the gold miners to gold. So wake up. Something's just beginning. You don't break that spread out and top the market. Okay.
So this breakout, again, we're recording this on Thursday, the 25th. So
yeah.
After our experience at the end of January, I guess we got to assume anything's possible on Friday. But nonetheless, if just the price of the XAU or just the miners in general relative to gold
Stay where it is right now.
just stays where it is through
Yeah.
Thursday and Friday, so that anybody that's watching this over the weekend can look this up. You're going to have this massive breakout similar to gold versus the S&P at the end of November.
Yeah. No, and therefore, recall what gold did versus S&P when it broke out in November. It wasn't just that it did better since then versus S&P. Gold net price exploded. $1,000 in 3 months. Okay. Even in a pullback, it exploded $1,000 where we are right now. Okay. We're off the high, which was 5,600 area. So this spread is very important to watch now, the gold silver miners versus gold. And then there's another set of charts that also speaks, and it's a table pounder as far as we're concerned. That's silver versus gold. And this chart, top of that page, you'll see that it goes back to 2011. Now, why go back then?
Okay.
Well, 2011 is when silver had that bull market run up to $50 for the second time. Okay. And in April 2011, it reached 50 again, like it was in 1980, and it peaked there. Okay. The spread at that time, which you divide an ounce of silver into an ounce of gold, reached 3.1%. Okay. We don't do the ratio. We just divide it as a spread. Okay. But you'd exploded from 2% or so to 3.1. And then the spread peaked and dropped back down in the subsequent years since 2011. And recently, last year, got below 1% again.
Yeah. I'm doing that. I was thinking the same
silver's going to be free versus gold, I guess. Okay.
Yeah.
It's sort of like the miners versus gold, off the page cheap. Okay. Well, that spread, silver versus gold, broke out through our first breakout level as of the November close. In fact, it went up even further in December. There's another breakout level you can see on that chart. There's two horizontal lines. But at the price of the first breakout on that spread, the November close, silver was $56. Okay. Yeah, we're off the high about right now, but where are we? 88 as we're speaking. Okay. So December, January, now into February. 3 months later, we were at 56 at the November close, and now we're 88. Not only did the spread break out favoring silver over gold, and it surged, the spread did, but silver's price surge was massively more, even with the pullback that we had off the January high. And that spread, in fact, is making a higher high this month than it did last month, despite that pullback. So again, when the spread breaks out, expect price dynamics in that leader category, in this case in silver. Now, it's our view that this search for new reality in silver is going to get us up to that 300 to 500 zone, okay? But probably very quickly, because when this spread breaks out, like it just did in November, usually within a couple quarters of that breakout is when you get your gusher, where you go ape on the upside in price.
Yeah.
We're expecting silver to reach that new reality basically by this summer. So another 3 or 4 months. Because usually these spread breakouts, they yield their results within a couple quarters of the breakout. They yield most of their results. And so silver, if it's going to seek a new reality, can easily be back where it was in 2011. 3.1% the price of gold.
Yeah.
The timeline framing is critical for investors trying to understand where we are in the cycle. Oliver's spread breakout signal, when silver broke out versus gold on the monthly relative performance chart at the close of November, is the starting gun for the current surge. 2 months and 2 weeks into that signal, the correction arrived. Oliver expected it, but expected it later, around the midpoint of a 6-month surge cycle. The correction arriving early is not bearish. It means more time before the summer target, which is actually a more comfortable entry point for late investors. The MSA entry signals at $35 and at the 50s in November are the correct reference points, not the $120 intraday high. From those entry points, the position is still deeply profitable. The "you got bagged at 120" comment is important discipline. Oliver does not pretend those buyers are fine, but he also says the long-term assessment is unchanged regardless.
What about when it was in 1980? It was 6.5% price. Good grief, right now we're 1.68 or something, okay? You could double, triple the price of silver relative to gold just to get to the old highs. on the spread. So all these factors are saying sudden, now, and new reality.
Yeah.
And then when we
Yeah.
do the silver miners, that's a chart at the bottom of that page, you'll see silver miners are broken out versus gold miners, echoing the breakout of silver versus gold. Conclusion: be in the monetary metals, be more focused in silver and the silver miners.
I'm doing that math in my head.
Okay.
I mean, the gold chart since the breakout about this time 2 years ago has followed us. I mean, anybody can pull up a weekly chart,
Yeah.
just a price
Yeah.
chart, and see it. It goes up 20% and goes sideways. Goes up 20% and goes sideways. Another 20% takes it to 6,000. 3.1% of 6,000 is 183.
Yeah, well, the gold in its prior bull markets, by the way, it usually doesn't do that layered process all the way. You'll do
Yeah,
that
not interesting.
4 steps up, 2 steps back process during the bull trend. But then suddenly in the latter part of the bull trends that gets you to the new reality, you go more vertical. The behavior changes, which fools people because they're used to the old layered behavior. And they
Right.
think it's going to, once you've made a high, you're going to stay there for 4, 5, 6 months.
Yeah.
In a range, or you're going to pull back. Don't expect that this time. If gold
Just-
matches its bull market peaks of 1980, 2011, in terms of the ratio dimension of the bull market from bear low to that bull high, bear low to the bull high, those were both 8-fold moves. Gold's bear market low was 1,050 in 2015. 8 times that says I could go to $8,500 gold just to match the dimensions of the prior 2 bull markets. And what's really curious is that we've had this analysis for quite a few months now. Not saying we're just going to go to 8,000 plus. That's just the norm. I mean, we'll probably go well beyond. Suddenly now some major brokerage firms, big name firms, have come out with similar numbers, saying, hey, we could see $9,200 gold. JP Morgan, I think, just came out with that. Based on certain mathematical relations to monetary degradation and so forth and so on. But a lot of big firms are now coming out with our numbers for various reasons, which is interesting. But I think that this bull move is now in the acceleration phase, where we're going to get most of what you're going to see, most of the rewards you're going to get if you're long will occur between now and summer.
Michael, what would have to happen? I mean, you've been on this, like you said, since June, reiterating things last year. I remember you talking about, it's going to get to 80 by the end of the year. And I was like, my God, I love you, Michael, but geez. And then here we were. And now, so what, this is all very compelling, and you see the numbers for the metal and you translate that to the miners with their leverage versus their margins. And you think, well, I can certainly see why then the gold shares and the silver shares should be breaking out as well as a ratio. My last question is, what would cause all of this to reverse in your mind, to go, you know what, we're going to have to rethink this?
We don't see the technical dynamics for a top. And when we see a top, and by the way, we do call tops in gold. 2011, 3 months off the high, we said, that's it. It's over. Bear market coming. Well, the bear market really didn't start to unfold till 2013.
Right.
But we labored off that $1,920 high in late 2011, dropped down. And in December of 2011, we said, we're bearish. And it floundered for a year and then finally crashed.
Okay. Yep.
But there were reasons for that, not just the price chart. There was a momentum structure. When you plotted the annual momentum of gold versus its 36-month average, for example, it oscillated. You had an 8-point uptrend line that you broke. You couldn't see it on a price chart, but on momentum said, God, you just blew the bridge over the River Kwai, man. Okay. And then we said, that's it. You're done. And it took a while to collapse. It finally did. We don't have any such structure set for gold and silver right now. In other words, before you really top and have a major pullback, like silver goes to 500 and then pulls back to 300, let's say, probably you're going to have momentum structures develop, and they're not there now. You haven't even developed the structures up under the market, where if you sneeze off the high, you're going to break the structure. Right now, any structures we have that you could break and look at a momentum chart and say, oh, it broke its trend, they're not even near the market.
Got it.
So therefore, we do not think there is any major downturn potential here.
Not yet, huh?
Yeah. Period.
Well, my friend, You know, you can count me as a fan. I know at my TF Metals Report site, you've
Okay.
got fans galore. And I know Eric, when Eric and I did our year-end wrap-up a couple months ago, he was raving about the job you do. Tell everybody more about momentum structural analysis, where they can find your work
Well,
and
it's
where they can
olivermsa.com, olivermsa.com. Ask for some sample copies. We explain our unorthodox methodology there pretty well. It's not what you're used to seeing, normal price chart stuff, and we've been doing it since 1992. So, and we look at all four major asset categories. We don't just look at gold and silver, although right now that is our table pounder. That is the asset to focus on.
And I've seen, Michael, in your regular reports, because you put out a weekend report, and then during the week there's stuff that comes out. You point out some of these same anomalies that you see in individual shares as well.
Yeah. So we try to find the outperformers. Anytime a sector is going up or down, there's going to be stocks within the sector that are outperforming the sector and underperforming or par.
Oliver's Bitcoin call is among the most precise forecasts in this interview, and the methodology is exactly the same he applies to precious metals. The bridge over the River Kwai structure on Bitcoin's momentum chart was the structural floor that, when broken at 107 and 102, triggered the crash. Price was still ascending. Charts looked bullish, but momentum had been building a floor for the same level repeatedly, which in MSA methodology is not support. It is a structural weakness waiting to break. The fact that Bitcoin hit $60,005 against a minimum target of $60,000, called when Bitcoin was well above $100,000, is a remarkable demonstration of the precision of the methodology. The broader warning about non-crypto companies carrying hidden crypto exposure is the most actionable piece for equity investors. The financial contagion from a Bitcoin bubble burst will appear in balance sheets of companies that don't market themselves as crypto-related.
And what we try to do is every month we sift through most of the mining symbols. We try to define their relative performance to GDX, for example. Which are they doing better than GDX or not? And we plot that. And we technically analyze it. And so there are always going to be miners that beat GDX on the upside. And that's where you'd like to prefer to pick the better ones. Although frankly, right now, I think you could throw a dart at the whole sector and come away smiling big time in 3 to 4 months. So
I can sure see how it all connects. Like you said, if the metals are going to keep going and those margins just getting
the
better
miners
and
are
better,
back to their highs.
then why wouldn't
notice
they?
that?
Yeah, right.
The silver miners are back to their highs, gold miners back to their highs. So the miners have suddenly said, hey, we're leaders now. We're not followers. And we're underpriced relative to that which we get out of the ground.
Yep. Fascinating stuff, Michael. Like I said, when Michael Oliver talks, people listen. Hopefully you've been listening, my dear reader, and that you flag this and go back and listen a couple of different times. Obviously, thank you, Michael. We've reached the end of February. I can't even, we're already a sixth of the way through the year. They say time speeds up as you get older, Michael. You agree with that?
Oh, yeah. And sometimes things get really good. This is a major event we're looking at here in the monetary metals. This is a lifetime event. Okay.
Fun to go to work every day, isn't it?
Yeah.
All right. So anyway, look, February's done, but March is just starting. There's going to be another full slate of information coming from Sprott Money. So hit the like button.
The oil call mirrors the silver call in structure. A market that has been held well below its monetary degradation adjusted fair value, a long-term momentum breakout just confirmed, and fundamentalists who are the most bearish they've ever been, which is Oliver's contrarian signal that the bottom is in. The Bloomberg Commodity Index getting a momentum buy signal at 106 in October is the macro confirmation. The broad commodity complex has turned, and oil was the last lagging component. When the lagging component of a commodity index complex catches up, the move tends to be the most violent because it has the most distance to cover. The oil-to-silver ratio at historical lows is a remarkable data point. It means that in the new monetary reality, where silver is repricing toward its true monetary value, oil looks even cheaper than usual on a cross-commodity basis. The 50% target to mid-$90 in the next quarter is not an aggressive call given that oil was at $130 just 3 years ago.